Join us now, Johanna Kyrklund, co-head of investment and group chief investment officer of Schroders. Today is your 100th year anniversary in New York. And I'll tell you why I'm excited. I'm excited because you're not going to talk individual stocks or even sectors, because you have so much money under management. We're just going to talk global equities, global fixed income, global commodities.
Yeah, big picture.
I'm excited about that. And you don't have 881 billion under management. You have 881.5 billion. Have you checked?
I'd like to be accurate.
Have you checked in the last? I mean, things are moving right now. Anyway, I was fascinated by a lot of your comments. So, global equities or economies used to be kind of in sync. You point out, one of the first things you point out, there are big regional differences now.
Yes, I think it's basically because we've had the revenge of the rate cycle. It's come back. You know, in the years where everyone was pinned at zero, you saw very little divergence in rate cycles. And this year, we've got very different conditions around the world. The US is still a little bit too hot for comfort from a market perspective. China clearly very sluggish. Europe slowing very markedly. Japan on fire. We haven't seen this kind of regional divergence, I think, since probably the early 2000s. That's the last time I saw that kind of divergence.
As a result, and with bond yields stabilizing, you're going to overweight U.S. equities because of this backdrop.
Generally, yes. I mean, I think we don't expect a recession anytime soon here in the States, and we think the path of least resistance is still for the S&P 500 to continue to climb. So, yeah, we're still risk on, but it is very much a U.S. story. I mean, we know obviously about the dominance of the Magnificent Seven here in the States, but also if you look more broadly around the world, equity markets have been struggling a little bit more elsewhere because economic conditions aren't as conducive. Yeah.
But you're out of U.S. Treasuries in terms of the 5-year yield.
Well, we see, I mean, I probably wrote that a few days ago. Things move very quickly. I think
you're back in?
Well, we haven't gone back in, but I think that the front end is quite well priced now. We've been avoiding the 10-year because of uncertainty around the term premium and, you know, still not quite ready yet to buy that.
But European investment grade.
Yeah, we've owned that all summer. Because, again, in Europe, things are slowing. Actually, the investment grade market there is very high quality. You get a yield. The key is we need to beat cash somehow, right? That's the race that we're facing right now. And so we're looking for opportunities to do that, yeah. But in Europe, you know, European investment grade will beat cash. And, again, I mean, even high yield in the States we still like for now.
You do?
Yes.
Because no hard landing.
Because no hard landing.
How often do you go to your conservative clients and say, we really like commodities? You like commodities? Yeah.
Well, it's funny. For the last decade, and we've been talking very much about a kind of regime shift in markets. For the last decade, we didn't touch commodities with a barge pole. But actually, it's really since 2020, we have been allocating more to commodities because, again, you have sort of a bit of deglobalization going on, geopolitical tension. People keep asking me, what do you own for that? I'm like, well, commodities are a good hedge against that, if that's what you're worried about. Inflationary pressures. So we keep, and again, the curves impact backwardation in many cases.
What kind of commodities? I mean, do you look at copper? Do you look at the metals? Do you look at oil?
So over the summer, we were focused very much on agriculture and energy. Okay. We were avoiding the metals because of what's going on in China. But as we've entered this quarter, we've gone fairly broad. Because actually, although we don't expect a rapid reacceleration in China, and I think, you know, ongoing discussion of fiscal support, it reminds me a little bit of Japan in the 1990s. We're always hoping for a fiscal package then. But equally, pessimism is a bit overdone now, I think, on China. We're seeing an improvement in Asian exports. And so actually now we're happy with the border exposure.
The grains, though, how much of that is just a play on the war in Ukraine?
Well, I mean, if you look over time, agriculture is highly diversifying. It's correlated with the weather, actually, more than anything else. So in that sense, it's diversifying exposure. But yes, it does give us also a hedge against what's going on in Ukraine.
You like gold?
Gold's still a little bit early because we see gold as a play on real yields. So it's linked to the view on bonds more broadly. But again, every day that passes, we're getting closer probably to buying bonds. I mean, with this kind of volatility.
You're getting closer to buying bonds. In
the sense that as they reprice, they get more interesting. So we think gold could be very interesting as we move into the first quarter. It's just a little bit early still.
When you're looking all around the world, do you have a different view of how central banks have performed in this environment? Who's done really well? Have they all been crappy or...
No, actually, I think they've been getting a bad rep. I mean, I think they've been dealt a very difficult set of cards. I think the Fed actually has been very clear for 2 years that they were raising rates and they're worried about inflation, and the market kept ignoring them and trying to price a pivot. But actually, I think they've done a good job. I think that, you know, in Europe, again, you know, the ECB maintains quite a lot of credibility. Bank of England has a complicated set of circumstances. So maybe, you know, it's a little more unpredictable there, I would say. I don't want to be too negative about our home central bank.
It was interesting because Jamie Dimon just said yesterday, I think at the FI conference the day before, he said those forecasts haven't been right in years.
But to be honest, all economic forecasts have been pretty rubbish this year. Everyone was expecting a recession. I actually think if you look at what they've done on rates, they've been right. And you know, again, it's just the markets kept trying to say, oh no, they're going to back down, they're going to back down. They've been right not to.
I'm going to use that on you.
The rubbish?
Yeah.
I like that term
rubbish.
too. That's really
Andrew, that's rubbish. Just get ready for that.
Good. You sound so nice while you're saying everybody's forecasts are terrible.
Can you use the word? We can use the word rubbish on in a U.S. show. If you were in the UK, could you use that on TV?
No, I know a word you can't use.
Yes, it's not a rude word.
It's not. Okay, I just didn't know.
I know a word you can't use.
You've gotten in trouble for it.
Wilfred.
Yeah.
I got in a lot of trouble. I'm not going to use it. It begins with a B.
Oh, I don't know that word.
I forget
the British one. B-O.
Oh, yeah, you can't use it.
Oh, yeah.
Yeah,
no?
right. Just...
No, that you can't use.
All right, hold your tongue.
I'm PG.
Final question for you. Snap. Bad revenue outlook. Do you like the stock? Answer the question. No, I'm kidding. I'm going to shine a light at you. No, not a. No, it's in a U.S. tech. Yeah, you don't want to know. Yeah, we like big. I like big picture sometimes. Sometimes I don't like, trying to micro.
Well, and I think that's been the story of the last 2 years, was actually stepping back and recognizing we were moving to a new range for yields and for rates, and that maybe something was shifting.